From CRI Simple Numbers, this is Profitability Playbook, the Simple Numbers Podcast, a podcast for those who champion market growth and anchor the nation's economy, small businesses, and entrepreneurs.
Hey there. Welcome to the Simple Numbers Profitability Playbook podcast. We have some special guests today, but right now we have Greg and Brandon. And for the new guys here, Tim and Rich, we'll introduce you in a moment. That is a mouthful. Simple Numbers Profitability Playbook podcast. So we're working on that.
You got it down though.
P cubed is my recommendation, but I don't know if we'll go with that. But
I don't know if we're cool enough to pull that off.
Yeah, that's right. That's right. Well, Greg, you called this meeting, man. What do we got Rich and Tim here for?
Well, it's really a great honor to have Tim Stack and Rich Armstrong from Great Game of Business and SRC Holdings, Springfield Remanufacturing. Many of you that follow the concepts of open book management and Jack Stack's original book, which I still recommend highly to date, one of my top 5 business books of all time in the Great Game of Business. And I have to go back and tell the story of Tim and Rich. So in 1996, I got to go to the first 2-day plant tour event at SRC and was just totally blown away. And I counted in probably one of the top 5 things that put me on the path to doing simple numbers, because when I got to do the tour of the plant floor, I saw machine operators that had no accounting education background talk about balance sheets, P&L, and cash flow better than any accountant I had ever encountered. And that really led me to believe that, there's something to really looking at numbers in a more practical, functional way, but also just teach, reteach, apply, reteach, and apply, but put the tool in the hands of the people that actually make things happen. And just, they've always been a fan, have been able to, visit multiple times, to Springfield, Missouri. And so just a huge fan, and certainly hope Jack's doing well. He's just one of my favorite people of all time in the world of business. I'll let you guys introduce your roles, in Rich being more the Great Game of Business coaching side, and Tim, you in terms of SRC. Give the folks a little bit of an idea of kind of your role in the business these days.
Tim, do you want to start?
Sure. Yeah. Well, I appreciate that opening is humbling, but we appreciate it. We're really proud of our origin story, and we try to hold as closely to it as we can, even today, 43 some odd years later. But I'm Tim Stack. I'm with our holdings group. Now we have a holdings company, and we try and keep it really as small as possible. Kind of goes in line with Greg referenced, where we want to empower all of our folks from the shop floor all the way to what we call our plant managers or our general managers. But so we have 10 operating entities underneath our holdings organization. And what I'm able to do, or what I get to do each and every day, is to work with a few of our different facilities, our operating entities that are really standalone businesses. So one's out of Lexington that does big mining equipment, remanufacturing space. One does reverse logistics related to remanufacturing. We have divisions in both Springfield and Joliet, Illinois, and then our SRC Technologies group that does electronics and batteries, and really kind of that next gen technology stuff.
Yeah, Greg, thank you. And thanks, Mike, Greg, Brandon, for the invite today. I really appreciate it. Greg, you've always been a great advocate of what we try to do with open book management, specifically what we're doing at Great Game of Business. Again, Rich Armstrong with the Great Game of Business. I spent about half my career. I've been with SRC for 35 years. So I spent about half my time with SRC within the operations, ran one of our divisions for a number of years, and then came over in 2005 to the Great Game of Business. And the Great Game of Business is a wholly owned subsidiary of SRC Holdings. It was a company we spun off in 1992 after the publication of the book and the interest in all of this. We started doing training and workshops and that sort of offering, and then eventually got into coaching. So most of our business today, the majority of it is coaching organizations on how to implement these practices within their company. And I was the president of that company for about 17 years. And just recently I am now out of that role and just coaching about exclusively. So I have about 7 clients that I support today, and some mutual clients that we have, Greg and Mike, as you guys know.
Yeah, that it's one of those that like I said, having the opportunity to have gone to the event. I think I've been to the gathering of games that you guys hold every fall, probably 4 or 5 times, and just really enjoy that experience and getting to see. Not only are the people open within their businesses, they're so open amongst each other, to share real stories. And that's kind of the way Simple Numbers really is we really like getting companies together and people opening up and sharing things together. And we've seen even one of our exploding areas of practice is running mastermind groups, either for ourselves or for other people, to do that sharing. And I think, Jack or Tim, I remember your dad saying, to an audience, somebody asking the question, says, "Aren't you afraid that somebody looks at your numbers?" And he goes, "Well, they don't have my people. I don't care if they have my numbers." And that has always stuck with me. So, but Tim, really kind of interested. I mean, this is an interesting time in the world of the U.S. economy, and certainly you guys are in a lot of areas that what we call necessary businesses. Some of the things that we shared with our economic data that we track monthly, with our client base, we're certainly seeing the necessary businesses be fairly steady, but certainly not exploding, in growth. But definitely the discretionary businesses have a little bit of a challenge in that. Just give us kind of an economic picture of what you guys see on the ground of how the economy is interacting with you right now amongst all your portfolio.
Well, I was talking to somebody the other day. I was saying that the market sentiment, or what you hear on the news, seems to be a lot more scary than what we're experiencing. And so kind of reconciling that and ensuring our folks, hey, I know what you're seeing, I know what you're hearing, but what are we feeling inside of our organizations relative to orders? And I think there is a lot of uncertainty, but like you mentioned, Greg, we're heavy in agriculture, construction, automotive, on highway truck. Those still need to go. The farmers are still getting out there. Our focus is still to provide a really high value proposition to our end users. So I think where we're kind of getting caught in the middle is, what are people doing with their inventories? Because that's how they hedge their risks. And we're kind of a couple steps away from that end user. So we got to be very smart about strategic inventory, but then also not tying up so much of our cash that it doesn't leave us opportunities to do other things. So, I think when we're looking year over year, we're hoping to have a flat to slightly up year when I just look at base business. And so when we look at that, we say, okay, what can we bring on to gain market share, maybe start new ventures to overcome maybe that flat base. And that's always what we try and do. And we're looking out 12, 24, 36 months. Where is our growth coming from? What will be susceptible to a downturn? What could overcome a downturn if we start a new venture and you start at zero? It really helps to kind of minimize those peaks and valleys that come with some of our base business.
Yeah, and that really kind of speaks to, I think, one of the core tenets that SRC has always been good at is getting your people to forecast. I know, we talk about it constantly. We build it into our models that we go over with our clients, but give us some insight of, the what you guys challenge each of your operating units, kind of that forecasting rhythm that you're asking them to do. And like I said, you're asking people that are probably not necessarily CFOs and that level of financial people. You're asking, the people who turn the wrench to do forecasting.
Yeah, we are. And typically they feel it before anybody. They know when it slows down, or they know when it speeds up before anybody. And if you don't walk them through that and show how that translates into the cash flow, balance sheet, income statement, they draw conclusions that are way more drastic one way or another. We're really, really doing well, or, oh no, the sky is falling, we've got no more work. But yeah, we ask every week all of our companies forecast, okay, how are you projecting to end this month versus plan and versus what you said last week? And we ask them to update their year end as well. So that's all, again, cash flow and income statement. And then we consolidate those numbers and we send them out to all of our other divisions, all of our executives, and really whoever wants to see that. We post them up in the facilities to say, okay, where are we projecting to go? We think looking forward is so much more beneficial than just looking backwards. You can't really do anything about it, right?
So let me emphasize what you just said, because you said it so casually that the listeners, I want you to understand what he said. He said they forecast weekly against what are you going to do this month compared to the plan and compared to what you said last week.
And I hate to tell you that I don't want people to listen to this, but I don't want our folks to realize that that's abnormal. So
it's not. It should be. We should make it normal.
Yeah. Let's normalize forecasting. We can make t-shirts.
Well, how many people? I mean, and I know Tim, you got your stuff you're working on, but with us, like, I mean, I don't know how many times we have clients like, oh, we built a budget, and they look at it once a year, maybe twice. They fit all. So,
yeah,
that's a good point.
I mean, that still just continues to this day, and I keep reminding people of that, when they say, oh, it's so hard. It says, no, it's not. You got to exercise that muscle. Forecasting is a muscle, and let's work it. Yeah. So give us an idea. I mean, for all of the business coaches, I mean, we work with all different coaching, and this is my, we love all business coaches, all business processes, because we feel like we fit a nice little financial piece underneath all the coaching disciplines, but I think you guys were really the first literal process driven rhythm business that I ever encountered. So give us kind of an idea of that rhythm that you guys go through, monthly and quarterly and annually.
Rich, you want to go over the HIP?
Yeah. It's kind of interesting. I wanted to just touch on that comment about forecasting weekly too, is that one of the things that's really crazy is it's not the CFO that's doing all that forecasting, right? They're maybe gathering all that information, but these numbers are truly coming up through the company. Yeah. Everybody has certain line items they're responsible for. So that process is a collective effort, and it starts with those rhythms you're talking about, Greg, is that we have a weekly rhythm we go through where there are so-called pre-huddles that people are gathering up information from their departments or their line item ownership. And that numbers are brought up to the leadership group and the overall company to see what that big picture looks like. And all through that process, I think what's important, it's not as necessarily just trying to be accurate on the forecast, but how can we influence that forecast? If it is not hitting the targets that we want, what can the organization do to correct those variances? So that conversation, that weekly rhythm from pre-huddles to the big picture, and then those numbers fed back out to the organization to actually do something about them, right? To run some different plays or whatever the ideas are. And that's that weekly rhythm. Of course, we have also what we call the high involvement planning process, which is really, we're getting those horizons out further, right? Rather than just, the weekly or monthly or 90-day, view of this thing. We're looking at it on an annual basis as well as 3-5 years out. And that kind of, that same kind of forecasting, same as the huddle cycle, there's a planning cycle behind it that happens, quarterly and twice a year, where we're really bringing the marketplace to everyone in the organization and making sure everybody understands what it takes for us to compete externally, and what we can do to improve the business from a longer horizon, right? From 3 and 5 year picture as well.
Well, the thing that I think you guys were the first company that I would say is more of a portfolio entrepreneurial mindset rather than a serial entrepreneurial mindset. I mean, I know you guys have bought and sold some companies, across the years, but I really do see, the marketplace is probably going to be more mimicking you in the future than anybody else, because it's having, there's an optimization of each line of business that you do, but you're going this way in some things that are related and some things that are totally unrelated. So talk a little bit about, kind of your overall strategy of, how do you choose to go after a business that's in the SRC portfolio?
Well, yeah, I think we're very confident in the system that we have. And I think Simple Numbers has a lot of common themes there, in that we create a system that allows people to make decisions based on data and not emotion, which helps in so many different ways when you're trying to bridge the gap between the shop and management, when you're trying to say, should we do this or should we not? Really takes the emotion out of it if you've done the work up front to say, here's where we want to be, and you can quantify where you want to be. So I think when you're talking about a systematizing the entrepreneurship, we find we got people that could take a company to 10 million and then the wheels fall off, because then you got to put processes in place and you got to do this and you got to need procedures and I need HR to come in and I need safety. And well, we're able to kind of drop this system in and give those entrepreneurs the guardrail. Some still have trouble growing it, but at least gives them some of that framework to say, here's the pattern. And it walks what we feel like is a really good line between, hey, this is still your organization, but we're giving you this system to implement to help you still be yourself, but be yourself even more and kind of leverage your folks. So when we're looking at companies to start, and really when we look at our 5-year, it really comes down to, do we have the talent to be able to execute on that? And I think we're in a point of time in our company where we can be a little more choosy about what we want to get into. If you know the origin story of SRC, where we started out with a debt to equity ratio of 89-1, it's a real scarcity mindset. So, there's a lot of talks now about how do we keep what got us here, and that, let's be tight, make sure our balance sheet is strong, but also let's not just take any opportunity that comes our way, and let's really leverage things like what you guys do at Simple Numbers and say, is this a healthy opportunity or is it not?
Yeah, I don't think anybody wants to repeat your origin story of finding the banker that makes the last loan before he gets fired for making bad loans.
Right. Yeah.
Hey, I listened to Jack Stack speak, and I still remember this comment. He told that debt to equity story, and he goes, well, I needed a bad loan, so I did what any smart business guy would do. I went to a bad bank.
What's funny about last year, we were creating a presentation where we had this story, and he finally just threw his paper down. He said, I'm tired of telling people that we're broke. We're not broke anymore. Story, we got to tell it.
And it's a great story because it's also the story you got away with. And I think a lot of times, I just got back, I get the opportunity to chair a week-long executive ed program at Wharton Business School for EO, Entrepreneurs Organization. And what I kept trying to stress to those guys is, I took several case studies of those fantastic stories. And I said, yeah, I want you to understand, what's underneath this fantastic story. It can't be repeated because they got away with it. And you do not want to follow that as your example. You just live to tell about it. Let's stick to the things that have much higher probabilities, in that process. And so when it comes to planning, for people that kind of have this, I think a lot of our community, we're fortunate. We have a lot of really good clients that are well capitalized. They're optimized in their business within their market. They grow when the market lets them. They pause when the market isn't there. They don't try to create something, and force it, when it just isn't there. And so I do think we have a lot of people that are looking to be more like an SRC in the long run of just adding those operating units. When you're doing the strategy of the 5-year horizon for that unit, is it top down? Is it bottom up? Or is it, more of a partnership of vision? How do those plans come together?
We get that question a lot. And Rich, you may want to add this. They're like, well, I got 100 people. Do I have to get all 100 people in a room and start creating a business plan? And the answer is no. You have to start with what the market presents. So we always ask our salespeople to bring the marketplace back to us. Like, out there, what do you think within our wheelhouse is something that the market is asking for? And then we come back and say, okay, can we execute?
Yeah.
Yeah.
So, I think we lost.
Yeah.
And on the next episode, we'll talk about SRC Holdings internet connection issues. They too. Forecast for that. Forecast for your internet next time.
There you go. Anyway, so we were talking about the in terms of where the idea. So I like that you're asking the salespeople to do one of our favorite things, and we've actually now put that at the step one of the simple numbers wheel of action, is you got to go assess the market. And if the market's not given, you got to look at some other thing. So once the salespeople come back with their market assessment, what's the next step, after that?
Yeah. So I think the first question I asked is, can we do it? And then we also try to push our salespeople a little bit more than just, hey, I had one person tell me that this is a good idea. So what data behind it supports not only is a good idea today, but does it fit into our overall strategy? And can we be profitable in the 5-year? Can we scale this thing? So I don't know about you guys. We get a lot of salespeople that are just very excited all the time. And that's what you want. Like, they keep banging on the doors, but then coming back, come down to earth. Let's get realistic. Let's sit with, if it's a manufacturing team, can we execute on this from an engineering perspective? And then meeting with our accounting team, what does it look like from a margin and cash flow standpoint?
Yeah. Speaking of scaling, something that came up in our Wharton class last week that I thought was the best discussion of growth and scaling I'd ever heard. And so one of our professors, Gad Allen, he did a section on growth and scaling. He says, growth is I'm just getting bigger. Scaling is when you see this, and he showed several graphs of this separation of here's your cost, and then now you have this exponential curve of output, yet costs don't follow it. Mm-hmm. And boy, that really just resonated with me, because it's a totally different thing. I mean, I think we incorrectly use the word scaling a lot of times when all we're doing is growing, because cost and revenue, if anything, costs are shrinking and the margins are shrinking as you grow, which we see a lot, but the actual act of scaling, of where you find that leverage point of where you get that hockey stick moment, and it may just, the scale may happen just for a moment and then reset. But I thought that was a real clarifying moment of him, talking about it that way, that I think I'll definitely use going forward. Have you guys had a business that you felt like you truly got into that scale moment of where you had the cost, we were surviving, but then you had that moment of where things separated and you got that uplift of margin and revenue?
Almost every one of our manufacturing plant is like that. And what we look at is when we can absorb our overhead, everything after that, you can price things more competitively. Mm. And where it gets tricky for us is, do you bank on the come, knowing that with volume, your overhead rate drops significantly? But yeah, one of our largest divisions, SRC Heavy Duty, was struggling for a period of time. And then when you're finally able to absorb that overhead, not only does it give you a little bit of confidence that everything you bring on hits really heavy to the bottom line, but they're able to price things a lot more competitively. So I think that's the biggest piece in the manufacturing is the overhead absorption.
So let's talk about pricing strategy for a second then. One of the challenges that we run into, I mean, probably pricing discussions is a topic of every call we have with our clients. And we're always the nudgers of going, have you pushed? Have you pushed enough? And what pricing is such a psychological event. When you get to that separation moment and you start to get scale, how do you fight the natural human tendency to compete on price rather than value?
Yeah, I think that's tough. It's being very disciplined about the margin that you've committed to over the long term. That's where I think when you reference back that 5-year, is saying every decision we make, how's it going to look in 5 years? And if you start cutting and cutting and cutting, and it's interesting, I think about I guess, I don't know, maybe 5-10 years ago, we were very hesitant to give price increases ever, and it got to a point during COVID, it was like, guys, if you're going to give a price increase, you got to do it now, right? Now is the time to do it, and you have those windows to do it.
Yeah.
All of a sudden, our sales teams were going out and they were getting price increases, and they're like, oh, well, wow, this isn't as hard as I thought, and I have a little bit more value than I had anticipated. And so then you got to be like, okay, pull them back and be like, okay, well, one of our general managers tells the salespeople, look, I don't want you to give a price increase every quarter, but I want you to talk about it every quarter. So he asked his sales team, say, hey, let's talk about price. Yeah. I'm not going to give you a price increase this year. We look pretty healthy. So it's part of the vernacular in the conversation. But we talk a lot about margin around here. And we never want to do more work for less money because we're very labor intensive anyway. So.
Yeah, I think one of the things we see a lot is also your best ability is your availability in things that are scarce. And so I think a lot of times salespeople have a tendency to not, I mean, you don't want to be abusive. I'm not suggesting that. But when you're the person that can deliver on time, on schedule, and the competitors, can't, that you want to try to get that extra value for being, when you can be there and respond quickly, there's a value to that. And I know it's walking a very difficult line.
But you have to know your competition and the marketplace before you can walk in there and say, I know I bring value in this area that the competitors do not. Keep
Right.
more confidence.
Yeah. Well, the next topic I want to hit is one that we run into all the time. It's probably the bane of my existence because I fall into the camp of behavioral economists that believe that many times incentive pay does not necessarily change people's behavior to the good, if any at all. But when we do get pushed into an incentive structure, our favorite is the one that you guys created, because I think of all things, it's the most measurable. It's I mean, any plan that's based on math, it has its difficulties to communicate, but I think you guys have been the masters and certainly have the length of time of success with one. But give us kind of an overview of how the SRC incentive plan works.
Rich, you want to cover that?
Yeah, yeah, I will. I think we call it the 10, 20, 30, 40 program that we use primarily within the SRC organizations. And what we're doing there is one of the first steps in all of this, Greg, is financial literacy, because we try to make sure our people understand what it takes in terms of reinvestment in the business. So we know that it doesn't end with profits, that the profits are then reinvested in the business. So what we try to find is, what is that threshold within the organization of profits that are actually needed to maintain the financial security of the business first? Right. And what does that look like? And then build a bonus program that if we can do better than that, then start sharing the sharing the rewards with our people. Typically, we start at a 50-50 split after that threshold.
Yeah.
That 50% goes back to the employees, but then we also have 50% going back into the reinvestment of the business as well, and ongoing value generation of the business. And that's another thing that we constantly look at, Greg, is that we have to be drawing long-term value, and every business needs to be looking at that. But for us as employee owners, I think we understand that better, because we can earn $1 today and pay a bonus out of it, or we can earn $1 that goes into retained earnings that we could get 10 times that in the future, right? So we try to balance that in terms of long-term and short-term rewards.
So when you're doing compensation strategy for SRC, what would you say is your base pay aim? Where in the market are you trying to hit your base pay relative to market? And then what is the significance of the bonus then relative to that base pay?
Yeah, so we try and be at market or a little bit above on the base. We have a very, very healthy long-term comp structure, and that's ESOP, that's bonus, but we also look at our healthcare that's really, really strong. We want to take care of our folks. So we try and align our compensation around our company culture and our values, spoken or unspoken. So the annual bonus can be 15 to 20%, depending on the company and then which position that they're in. And like Rich mentioned, that's paid out quarterly. So we want to give people with taste. You can get 10% of that in Q1, 20% in Q2, and all the way to 40%. Or if you get none of it, you could get all of that in Q4. So it keeps.
Yeah, because it is a cumulative. It's a cumulative number less what's been paid in previous quarters. So I love the catch-up process to that.
Right. So we have that annual on top of that base, which, we always say, look, we don't want to hang our hat on ESOP and say, look, you got to starve today, but you'll be able to buy a lake house when you retire. That's not what we want to do either. So we're constantly tweaking that. And, it's always hard, because what one person values versus another is very different. And the levers that you pull sometimes you're kind of hamstrung on ESOP and on, we'd love to be able to say, can we pay out a little bit of money from somebody's ESOP every year if they wanted it? Well, then you got hit with a loan and then they got issues there. But so we try and tweak it as we can. But
yeah, that's cool. Yeah, it's one of those that, that challenge is where do you fit? I mean, we run for our consulting clients, we run a lot of wage surveys. We have access to the Economic Research Institute's salary assessor program, so we can run a wage survey, any position, any SIC code, any location in the U.S. And that's been for them having access to that to then be able to set where in that band, and we kind of follow that same philosophy of, you want to be right around median to slightly above, depending on the that person's benefit, but then look at, where do they get that variable? And, the challenge is, we just see a lot of times, you do the big bonus and then there's just the big letdown afterwards. And that just, that's just a killer, at the end of the day. But Rich, I thought your point of the 50-50 sharing, that definitely aligns with what we talk about with our clients, because if the business doesn't share in the upside equal to or greater than what goes out to the employees, I mean, you're just giving away the profits and not gaining, as a business.
Exactly. And there's, a lot of talk about, capping. You mentioned that, Greg. I remember one of the first clients I ever worked with, they just refused to cap it and then was sharing a heavy weight to the employees, right? And their first year out of the gate, I think they paid somewhere around a 30-35% bonus to everybody in the company, and they loved the great game of business that year, right?
Yep.
The next year they paid everyone 17% of their wages, and they were demotivated.
Yeah.
And so you can set those entitlements, too quickly. And I think another thing is just the rewards is that, and Tim mentioned this, is that making sure that you're motivating people in different ways, because you don't really know what's going to motivate them. And when we talk about staking the outcome, bonus is one part of the stake in the outcome. Other things like healthcare and career advancement and, just pure everyday recognition can do a lot with people. So we got to make sure that it's just not always about the bonus check.
Well, and the next topic I want to touch, and certainly you may want to, talk about it as carefully as you want to, but you guys run some pretty valuable businesses. How many times a day does private equity knock on your door to want to buy one of your operating units?
I think there's some level of with being ESOP and the ESOP obligation, I'm hoping it kind of shields it a little bit, but we have conversations, but we also really feel comfortable with our employee owners. Like, I think same conversations on like unionization. And I think that's happened before in the past, not recently, where we just take it to our folks and say, hey, it's your employee owned. Here's what it would mean to you probably. And if that looks better to you than this, then it's up to you guys. And I think it's kind of disarming whenever you don't fight. And I think that's probably the same approach we would take if something like that happened.
Yeah, what's amazing, we've got some good data in some industries, like we got an HVAC group that there's some a couple of union shops, and then everybody else is private. And so our total LER concept of gross margin to all labor, I don't care if it's management and direct, that there's probably 80% of the service-based industries operate to a single standard of a 2. If you get $2 of gross margin for every dollar of labor, everything else works. It's just the way it is. Except if you're a union shop, you know what the lever number is for a union shop? You got to hit a 2.5 to get the same profit dollar that you would get being in a non-union shop. And that I always found that's just a pure extraction of the impact, what that union thing is. Do you want to work, essentially, 30% harder, to get, to get that benefit, because that's what it's going to require, out of the business. So it's amazing. So Brandon, Mike, any questions, thoughts you guys have for?
I was just going to kind of recap the nuggets, because there's been a gold mine of them today. This has been great. So for those that are listening, the things that jumped out to me that I think are worthy of you guys examining as you run businesses. So the difference between growth and scaling, I think that was great, Greg, in terms of a lot of folks don't separate the two. And the thing that just kept jumping out of my mind was management LER. As management LER increases, that's scaling. As top line increases, that's growth. And so looking at your strategy around that, love the concept around what will this decision look like in 5 years? Because there is such a tendency to think near term without considering the ripple impact of what's going to take place down the road. You may not give a price increase every year, but your sales team is discussing it quarterly with customers. Keeping it front and center. That's really great. That way it's not that awkward conversation. They know every time you chat, there's probably going to be a mention of it. Know your competition so that you can deliver on your competitive advantage. And we've been talking a lot about that the past 2 years. What is your competitive advantage? And, a lot of times we'll throw that out there and folks will just go, we're better. I'm like, well, people don't buy just saying you're better. You got to know your competition and where they're weak. And it doesn't end with profit. You have to reinvest. And we talk a lot about that with our clients, but I think it is a gap that their team doesn't understand. They think it ends with profit. No, especially in those businesses that have a high trade capital requirement, there's a tremendous amount of reinvestment. So those are some things that jumped out that you guys mentioned that I think our clients really can benefit from pontificating on.
Well, and I do think that lack of reinvestment is a plague of what you're seeing by private equity bought businesses that are struggling to achieve their objectives post-acquisition, because they want to strip all that out and say, oh, well, yes, we expect you to still grow, but no, we're going to cut these expenses because we got to have the profit number to make the loan payment that we did, to buy it. And it's like, well, wait a minute, you can't have both. I mean, there's a finite universe of cash flow there, that you got to compete with. So we actually like our clients, in the position that they can compete against the private equity backed folks, because we got some folks buying up some really nice operating units that the private equity guys are shedding. So this actually may be the first time in 15 years that you can actually find a deal buying a pretty decent business. So it's not too shabby. So cool.
Well, awesome. Oh, sorry. Go ahead, Greg.
Well, so Tim and Rich, what for people that want to learn more about Great Game of Business, and certainly maybe attend the gathering, do the plant tour, what how do they check out Great Game of Business and SRC?
Yeah, well, definitely hit our website, greatgame.com. One thing I would offer out there is, every other week we do what we call a Discover the Game webinar. It's free to anybody. You can step on for 2 hours and just get kind of a deep dive in what this is all about. And if this, it's a great webinar to kick the tires, because there's a combination of people that are just looking at Great Game, but also some long-term practitioners. So that may be a helpful thing. And we, of course, have our annual conference every year at the second week in September. And we'll be hosting that down in Dallas this year. And that's a conference of also about 30% of the audience are people kind of kicking the tires. And then the other group is long-term practitioners. And most of the sessions are actually delivered by practitioners. This is how we're making this work in our organization every day.
Yeah, super. Yeah, good job. And then certainly, several of the books, that have been done, Great Game of Business. And I think Jack did a couple of others after that. I'm slipping on the titles.
Yeah, Staking the Outcome, which is one of my favorite books. It's kind of tailored, a little bit niche for employee owners, but ownership community. But it's really a strategy book to me. I mean, it's really about scaling a company, right? All the challenges you have, from people to finance. And then he recently wrote a book called Change the Game, which profiles some of our long-term practitioners and just how they made it work in their organizations and how it is really better for people. So,
yeah, super. Yeah, and unlike a lot of business books that their flavor kind of comes and goes with the tide, these are just timeless principles. I don't think they ever go out of vogue. So really good.
Awesome.
All right.
Well, hey, great having you all on here. We have, especially, I mean, hey, you guys don't realize it, but this was actually a special appearance by Greg too. He just pops in and with some friends with him. So,
All right.
It was nice to have him on. As you can see, were you in an airport, by the way? See, that's why. That's the thing. He just flies in, flies out, kind of thing. So, awesome, guys. Well, we really appreciate you, and thank you again for coming on here and sharing your insights with us.
Great. It was phenomenal.
Everyone out there, will Brandon and I, maybe Greg, maybe not, we'll be back next week.
Thanks, guys.
Thank you.
If you want to know more about driving sustainable profitability for your business or are interested in learning more about CRI Simple Numbers, please visit our website at simplenumberscri.com. Thanks for listening to this episode of Profitability Playbook, the Simple Numbers Podcast. You can subscribe to Profitability Playbook on Apple Podcasts, Spotify, or wherever you prefer to listen to podcasts. If you liked what you heard today, please leave us a review. The views expressed on Profitability Playbook, the Simple Numbers Podcast, are those of the presenter and moderator and do not necessarily reflect the views of CRI Simple Numbers or the CRI family of companies. This podcast is intended for informational and educational purposes only and is not intended to replace professional advice received directly. Consult with your CRI Simple Numbers advisor or another trusted professional if you have questions about your specific situation.